Today we will be talking about economic inequality and financial inclusion. First of all, what is economic inequality? Imagine this scenario. You and your friends have a big box of chocolates to share. If one person takes most of the chocolate while others get only few or none at all, that is similar to economic inequality. So to sum it up, economic inequality is the gap between wealthy and poor in terms of wealth, income, and resources. A key driver of economic inequality is unequal access to education. People from lower income families often don't have the same opportunities to get quality education, which leaves them stuck in lower paying jobs. In addition, things like wage disparities between industries and the decline of unions, which once helped workers secure better wages and working conditions, have worsened the gap. Government policies matter as well. Tax systems that favor the rich or cut funding for social programs only increase the divide between the wealthy and the poor. Lastly, we have globalization. While globalization and new technologies have driven economic progress, they've mostly benefited those with the right skills or capital, leaving others behind. What is financial inclusion? Financial inclusion is all about making sure that everyone, regardless of their income or where they live, has access to affordable financial services: banking, savings accounts, insurance, and credit. These services help people manage their money, invest in opportunities, and plan for the future. The ultimate goal is to create a financial system that works for everyone, especially those who have been left out in the past. Although financial inclusion might seem like the perfect solution, there are barriers to it. Some people don't have the financial knowledge or literacy to understand how banking works, while others face high fees or complicated processes when trying to open an account. In rural areas, there might not even be physical banks nearby, which makes it harder for people to access services. Social issues like discrimination can also make it difficult for certain groups to get financial services. And in many places, people don't have access to the technology needed to use online banking or mobile payment systems, which just adds to the exclusion. What does economic inequality have to do with financial inclusion, you might ask? There's a strong connection between financial inclusion and economic inequality. By giving underserved people access to tools like credit, savings, and insurance, financial inclusion helps them build financial security. These tools allow people to start businesses, accumulate assets, and plan for the future, which ultimately helps reduce the wealth gap. So we can see that financial inclusion is one of the solutions for economic inequality. There are global efforts to broaden the space for financial inclusion. To start off, there is emphasis in the World Bank to create employment and enhance welfare through provision of enhanced levels of economic activity, which is through financial inclusion. For example, their USFAP 2020's influence was to encourage people to have better access to financial services, specifically via the internet. Similarly, G20 also affirms that majority of the population in the world can be emancipated through the provision of digital financial services. There are countries who are successful with the implementation of financial inclusion strategies. India has adopted Aadhaar, a digital ID system with PMJDY, which already reaches 1.2 billion people. Countries like China and Kenya have been able to apply direct government disbursements, mobile phone accounts, and a national financial integrate monopoly inclusive of the telecom industry and even the education ministry to help in growth. Lastly, we will be talking about the future direction of financial inclusion. To start off, fintech innovations represent a crucial opportunity to address these challenges and improve on the status quo. Fintech solutions such as mobile money transfers and microloans can help the less privileged groups by leveraging technologies. Investment in networks, low-cost connectivity, and innovative financial services will help close the digital divide in developing economies. For instance, EAMP has invested billions for this purpose, augmenting digital infrastructure in the Middle East, Africa, and Asia to enable the rural populace access financial services. Such structural transformation is expected combined with the advancement of fintech to provide affordable banking while stimulating growth, eradicating poverty, and improving quality of life.